Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome to the deep dive. Today we're analyzing a really pivotal piece of institutional research to help you navigate the year ahead.
That's right. We're going to be breaking down the 2026 year-ahead investment outlook, AI lift, and economic drift.
And that's from JP Morgan Asset Management, published on November 13th, 2025.
Our goal here is pretty simple. We want to interpret and discuss what this report is signaling for investors who are, trying to make sense of some pretty complex market dynamics.
Exactly. We'll get into the macro themes, fixed income, equities, all of it. But first, we have to be very clear.
Yes. This discussion is for informational purposes only. It's our interpretation of the material.
It is not investment advice and shouldn't be used to make any investment decisions.
Okay, so with that said, let's get into the core idea. The title itself, AI lift and economic drift, really captures the central tension for 2026, doesn't it?
It really does. On one hand, you have this powerful structural force from AI lifting parts of the market. But on the other, this broader economic drift.
And that's the challenge. The report suggests that while the U.S. economy looks resilient on the surface, making real progress in a portfolio is going to be tough.
Because starting valuations are already high, and that cyclical momentum just isn't there across the board. You have to be very selective.
Let's start with that macro picture, because it's a tale of two halves. The report suggests 2026 starts surprisingly strong.
Right, a surge in growth and inflation right out of the gate. What's driving that?
It's a fiscal story, plain and simple. It comes from the stimulative impact of the recent OBBBA legislation.
So the timing of the tax changes.
Exactly. The report calls it a bumper crop of tax refunds that will hit consumer bank accounts in the first half of the year. And that's expected to push H1 GDP growth above 3%.
So a temporary front-loaded boost. But that energy fades pretty quickly, right? The forecast for the second half of the year is much weaker.
It is. It slides all the way back to a 1% to 2% growth rate. And that's where the economic drift really starts to take hold.
So what are the headwinds causing that slowdown?
Two big ones. First, higher tariff levels. The thinking is that businesses have absorbed these costs for a while, but that can't last.
So they start passing them on to the consumer.
They have to. And that's expected to really start mid-2026, putting a drag on spending.
And the second factor?
Labor supply. The report is very clear that the dramatic drop in net immigration is now creating real constraints.
Which means job growth slows down significantly.
To a crawl, really. The forecast is for an average of only about 50,000 jobs per month. That's very weak, and it limits how much real consumer spending can grow.
And that's why inflation, even though it might peak near 4% early in the year, is expected to slide back down towards 2% by year end. The demand just isn't there to sustain it.
Exactly. And this all feeds into this idea of a K-shaped expansion.
Where you have the stock market after a third great year, creating huge wealth gains for one part of the population.
Precisely. That wealth effect is supporting high-end spending, luxury goods, travel, that sort of thing. But at the same time, middle and lower-income households are feeling the pressure from those tariff-driven price hikes and slow wage growth.
It's a real divergence. Now let's talk about the other side of that K, the AI lift. The amount of investment here is just staggering.
It is. It's not a niche theme anymore. Data center CapEx is already running at about 1.2 to 1.3% of U.S. GDP.
Which is an enormous number. You're essentially building a whole new utility layer for the economy.
And the adoption numbers show this isn't just theory. 9% of U.S. firms say they already have AI in production, and 44% are paying for some kind of AI platform.
What's interesting there are the knock-on effects. I mean, when capital spending hits that percentage of GDP, it's not just a number on a page. It creates real-world bottlenecks.
It does, and that's a key part of the interplay here. All this data center construction puts incredible pressure on utilities for power and on certain industrials for things like specialized cooling systems.
So ironically, the lift from tech actually contributes to some of the inflationary drift in other parts of the economy.
That's a great way to put it. Now, all of this volatility and this two-speed economy, it puts the Federal Reserve in a very, very tough spot.
You can see that just from the divisions within the FOMC. I mean, the last meeting showed dissenters who wanted no cuts at all and others who wanted to cut aggressively.
Right. They're trying to balance their dual mandate, but the signals are completely crossed. You have this tariff-driven inflation, which is a supply-side problem that rates can't really fix.
But inflation is still above their target.
Exactly. And at the same time, the labor market is slowing down. So the hawks are looking at 3% inflation and worrying about credibility, while the doves are looking at 50,000 jobs a month and worrying about a recession.
So the forecast is for a very patient, very measured easing path. The report is only penciling in, 2 or 3 rate cuts for the whole year?
That's it, 2 to 3 cuts. And that's a huge disconnect from what the market is currently pricing, which is closer to 80 basis points of cuts.
And that gap is where the volatility is going to come from.
Absolutely. The report suggests investors should be ready for a lot of recalibration. For positioning, that means duration management is key. The outlook sees the 2-year Treasury probably settling between 3.50 and 3.75%.
While the 10-year stays a bit higher, between 4.0 and 4.50 percent.
Right, which implies some modest curve steepening. Most of the rate decline happens at the short end of the curve.
Which is a big shift from the inversion we've been living with. How does that change things for investors?
Well, for one, it's better for banks' net interest margins. But for portfolios, it really reinforces the idea that you shouldn't be making a big directional bet on rates.
Instead, the guidance is to lean into the income.
Exactly. Focus on capturing the income that's available now in high-quality credit, in securitized assets, and in municipal bonds, where fundamentals still look pretty solid.
But with the economy slowing, selectivity has to be critical.
It's non-negotiable. This is an environment for active management, for finding the companies that are resilient to that economic drift.
And what about global bonds? What role do they play here?
They're an important diversifier, a way to hedge against some very U.S.-specific risks, like our debt levels and that tariff-driven inflation uncertainty. Plus, the report also flags emerging market local currency debt for its attractive carry.
Okay, so let's shift from the relative safety of income to risk assets. U.S. equities. The big question on everyone's mind. Bubble or boom?
It's the central question. And look, valuations are rich. There's no getting around that.
But the counterargument has been the incredible profit growth. I mean, 4 straight quarters of double-digit earnings growth, with another 13% projected for 2026.
It has. But that aggregate number hides the real issue, which is the concentration.
Right. The growth isn't broad-based.
Not at all. That 13% number is almost entirely dependent on the AI leaders. Since the start of the year, earnings expectations for the Mag 7 are up another 3.4%. While expectations for the other 493 stocks in the S&P are actually down 1.2%.
That's a stunning statistic. It really shows that the broadening out thesis just hasn't happened yet. Doesn't that make the market incredibly fragile?
It definitely raises the vulnerability. But the report comes to the conclusion that this looks less like a speculative bubble and more like the tumultuous start of a real structural transition.
And the key difference is how it's being financed.
Yes. This isn't like past bubbles that were fueled by debt and speculative cash. This AI build-out is being financed by incredibly profitable, cash-rich companies. Tech free cash flow margins are near 20%.
They're funding it themselves to meet real demand.
Exactly. It's real infrastructure being built, not just speculative hype. That's the core of the argument.
So if that's the case, what are the portfolio implications? How do you invest in that kind of market?
The key strategic shift is to look beyond the innovators, the big tech firms, and start focusing on the enablers and the adopters.
The enablers being the industrials and utilities that are actually building the data centers and providing the power.
Exactly. And the adopters are sectors like financials and healthcare, where AI is going to start driving real productivity gains. The report actually calls out financials as having some differentiated catalysts.
Like deregulation and the benefits from that yield curve steepening we just talked about?
Right. So the idea is to balance these secular growth themes with some quality value sectors.
Let's take that idea overseas. International equities had a huge 2025. Does that momentum continue?
The outlook says yes, and it's based on this idea that the earnings gap between the U.S. and the rest of the world is finally starting to narrow.
It's still a gap projected at about 10% for 2026. That's much tighter than it has been. What's driving that?
The report highlights 4 major structural themes. The first is simply positive nominal growth. The move away from negative rates in Europe and Japan is a game changer for their banks and value sectors.
Okay, what's the second theme?
The AI theme is broadening globally. Technology is now 27% of the emerging market index, with big players in Korea, Taiwan, and Japan who are critical to the supply chain.
The third is fiscal stimulus.
Yes, huge government spending, especially in the Eurozone. They've pledged massive amounts, like 5% of GDP, to defense and infrastructure, and that money is really going to start flowing in 2026.
And the fourth theme is a shift in corporate culture.
This one is really interesting for value investors. It's a focus on shareholder returns. Buybacks and dividends are becoming much more common in Asia and Europe. Last year, buybacks in Japan and Korea actually surpassed the U.S. as a share of market cap.
And international markets still offer dividend yields that are double the U.S. market.
Right. So even after the strong performance, the report's view is that investor positioning is still off-size.
Meaning that institutions are still underallocated to international stocks compared to their typical benchmark.
Correct. There's still a powerful reallocation tailwind that could continue through 2026.
This all brings us to alternatives and overall portfolio construction. That concentration risk in public markets seems to make alternatives almost a necessity.
They're integral. And the AI theme is a huge driver here, too. The report talks about a transfer of value from public markets to private ones.
How does that work?
Well, the public tech giants are the customers.
Yeah.
But it's private equity, infrastructure funds, and private credit that are actually financing and building the data centers, the power grids, all the physical stuff. They're the enablers.
So private credit still looks attractive then?
The premium is there.
Yeah.
But again, selection is key given the slower economy. For private equity, the outlook is for 2026 to be a good year for exits, IPOs, and M&A as financing costs come down.
And this all leads to the report's final, most fundamental point, challenging the traditional 60-40 portfolio.
The old model just isn't adequate anymore. The correlations have shifted. The report argues for an evolution to what they call the 60-40 plus model.
And the plus is alternative.
The plus is a dedicated strategic allocation to alternatives, private credit, infrastructure, real assets, things that provide diversification away from that extreme concentration risk we see in public equities.
So diversification isn't dead, it's just different. You have to look for it in new places.
That's the perfect way to summarize it. Bonds are attractive again, but they can't do all the defensive work by themselves anymore. You need that plus. And as you rebalance, you have to be smart about taxes, using things like ETFs to do it efficiently.
So to wrap it all up for investors navigating 2026, the key is to manage these two opposing forces, the AI lift and the economic drift.
It requires a really disciplined approach. In fixed income, it means prioritizing income. In equities, it's about looking for the broadening beneficiaries of AI.
And leveraging the structural growth overseas while fundamentally evolving your portfolio with that 60-40 plus framework.
That's the roadmap.
And we'll remind you one last time, this deep dive has been our interpretation and discussion of the research from J.P. Morgan Asset Management.
And this content is for informational purposes only. It does not constitute investment advice.
As we close, here's a final thought to leave you with. If the U.S. is going to spend over 1% of its GDP every single year on new data centers, what's the ultimate physical limit on our domestic energy grid? And how soon will that constraint force the decentralization of AI computing power around the globe? That's a physical reality that could shape the next decade of investment no matter what the Fed does. Thank you for joining us.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.